What I realize is like 95% of the investors that look at my deals will never go into the data room and look at any documents in the data room. They're essentially investing because they trust me and my judgment and my 13 full cycle exits, a track record to prove it. But it's really the 5% of like ultra sophisticated investors that are going in and looking through the documents, and they really, really appreciate that. Some operators, they only send you the pitch deck and the Excel model. I'm going to show you the insurance quote and the tax assessment, like everything, the CoStar report, the market comps. Like I'm going to have all of the evidence that supports the assumptions in the underwriting model, like in there in a data room so that you can see it. Of course, that leads to more questions, but the more that those investors dig in and ask the questions and get answers to those questions from me, the more they become interested in the deal.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Bryan Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Let's get started and reach those peak profits together.
Welcome back to the Peak Profits Podcast. Today we're joined by Elijah Brown, founder of Goldhawk Capital, a direct investor and equity brokerage platform for multifamily operators. After starting his career at a large REIT and contributing to over $4 billion in transaction volume, Elijah went on to launch Goldhawk, where he's acquired interest in more than 3,500 units and helped close over $500 million in multifamily deals. In this episode, we'll dig into capital raising, underwriting discipline, and what it takes to scale multifamily investments in today's market. Elijah, thanks for joining the podcast. We're excited to have you on today.
Yeah, all right. Thanks so much for having me on. It's really a pleasure.
Of course. No, you have a strong background in the space, big voice on LinkedIn. You've done a lot, obviously, as I mentioned in the intros. Why don't you tell us a little bit about yourself and kind of how you got to where you're at today? I know you worked at the REIT, you're at investment bank, and then kind of launched Goldhawks. Give a little intro more than what I explained in the intro.
Yeah, sure. So back when I was in college, I thought I was going to go into banking and did some internships. Actually landed an internship with a hedge fund, which was really cool. But I realized fast it was like the last thing I wanted to do. Those people, those analysts have a miserable life. They make good money, but it's really a brutal game. And I had watched a lot of YouTube videos, real estate stuff, and found rental property investing, and I really loved it and thought this was going to be the best way for me to build wealth. And so I determined while I was in school to buy some rental properties. So I got my buddies together because I didn't have enough money at the time, and we came up with enough money for a down payment on a single family house in Florida. And we put a tenant in there, and then we did that a few more times, and ended up getting a job out of school at a REIT. It's a real estate investment trust. And it was an analyst level position. So I got a lot of great experience over 4 years. But while I was there, I was also raising capital from investors and coworkers to buy apartment buildings. And so I did that for a while, built up the portfolio, and then a couple of years ago went off on my own to do this full time. And around the same time, I realized that I really didn't enjoy operating apartment buildings and operating rentals. It's just really brutal. I didn't like the operations of it. What I was good at was underwriting and raising capital. And so I pivoted my business just raising money for other people's deals. So what Goldhawk is now is we are both a direct investor in apartment deals, and I do that with funds from investors and myself. And then we also do equity placement advisory. That's where we'll go find like a family office or an ultra high net worth person or an institution, and we will connect them with the operator that's looking to raise the money and hopefully arrange a much larger check. So we do both of those things, but we focus exclusively on multifamily in the US.
That's awesome. I love to hear everybody's journey is always very different. And there's so many people that, like you mentioned, YouTube there is the starting point. A lot of people mention Rich Dad, Poor Dad as the starting point. you also started doing this while you're in college, which I also think is like really, really cool. Getting together with your group of friends ultimately to buy that first single family property. How quickly did you feel, or how quickly did you ultimately scale from that one? You said there that you did that a few more times, even while you were at college. Did your kind of core group of quote unquote investors slash friends grow, or did you take the money or equity that you had built up in that single family home to then roll that into essentially using the Burr method into another property? Like, how did you scale from that first unit into ultimately where you're at today with all of the assets you have?
Yeah, it's a lot of questions. So I had different investment partners on each deal. Many of them stayed with me and invested in many of the deals. And those first properties that we ended up selling, we reinvested that money into larger deals. Yeah, no, started off with the two single families while I was in school, and then shortly after I graduated, two more. It took a few years to get that first small portfolio of single family properties. And then it was year three, we bought the first sixplex in Orlando. And that was a total dumpster fire because we bought the crappiest C class property that just had all kinds of issues and structural foundational issues. Went through like four property managers on that deal. Ended up making a really decent return on it and 1031 exchange into the next deal. So we did that one, and then I did a fiveplex, and then from there we started scaling up into the 50 units and the 100 unit deals. When I started scaling up, I wasn't the only one involved. I at that point you need a team because it's a much bigger endeavor. I would essentially tack myself on with a partner and called ourselves co-GPs or co-managers in the deal. And I would play a certain role like raising money and underwriting, and they would do asset management and other stuff. And so that's kind of how I was able to scale by just focusing on the things that I liked doing, that I was good at, and then partnering with someone else who could do the rest.
That's awesome. And so I'd imagine that 6 unit was your first commercial, right? When you got over 5 units, and there's different type of financing, and obviously they're valued a little bit differently. And you probably learned a handful of lessons within that. It sounded like it still worked out very well for you. So can you elaborate a little bit on what you learned from that deal and some of
Yeah, I
the
was like
details?
22 years old, I think, and a residential broker brought it to us, and
Yep.
I got really excited and went out and got a 12-month bridge loan. Yeah,
Work.
we came up short on the capital raise, and so I had to go meet with the seller in person to beg him for a $20,000 seller loan, and somehow we got the transaction done. I was literally collecting $5,000 checks from my coworkers in the office, like going around with a
Wow.
pitch deck and pitching my coworkers while I was at work. Yeah. So, but the closing, raising the capital was the least of the issues. We discovered so much crap that was wrong with that. The contractors that would quit, and everything was more expensive than it should have been. The bridge loan, that was a nightmare. I didn't realize that it would take us so long to finish renovations and get the property stabilized, and then to have to go through an application process with a new lender. It's like, you really got to be done with your renovations within like 2 months to get started on the application to be able to refinance within a year. Never do that again. But yeah, we dealt with a lot of issues. Property managers that would lie, cheat, and steal. Contractors that would lie, cheat, and steal, and then quit halfway through a job and take the deposits. We dealt with like everything on that deal.
So that was almost like the textbook deal of everything that could go wrong there, Elijah.
Everything.
And
Unbelievable. Yeah.
you still said you got good returns out of it by the end, and
Mhm.
then you then 1031 exchange that
Mhm.
into the larger property. So again, you were going through kind of all of the different loopholes and the steps that it takes people many, many years to get to. And obviously, you mentioned there, it took you time, right? This wasn't something that happened overnight, that you went one, two into six, then into 50. Like, it does take years to ultimately build up that portfolio. But want to move slightly beyond that initial portfolio that you built into working at the REIT and ultimately working on around $4 billion worth of deals. You had the experience now from a few single families, then your first commercial building. then going into the opportunity to work with around $4 billion worth of deals, like what were the fundamental differences, and how did you take what you had learned in your owning of those properties previously into then the work you were doing at the REIT?
It was like completely separate and unrelated and like not connected at all. Actually, I took what I learned at the REIT and used that to make my real estate investing better. Things such as like Excel modeling and presenting, basic things like that. But yeah, with the REITs, with large REITs, it's like the way they transact. They're not going after these smaller middle market deals like what we do. They're going after the institutional quality, like $100 million plus transactions. And in the case of this company, occasionally it was $1 billion transaction because they'd be doing portfolio acquisitions or portfolio sales. I was there at a time when they were simultaneous. When I was there at a time when they bought billions of dollars worth of assets, but also disposed of an entire section of their business. They essentially sold $5 billion worth of senior housing assets, like senior living facilities. And so I was there for that. And so I was part of a lot of lease restructuring and disposition transactions, which is pretty cool. But yeah, no, I would say I definitely learned a lot about the corporate world, how to conduct yourself, how to present to investment committees and C-suite professionals, how to model cash flows, stuff like that. I didn't learn how to raise money there. I didn't learn how to, underwrite multifamily. So it was just very different.
Yeah, and you probably got this a lot yourself. And I know in raising capital ourselves, I often get the question is like, how is investing in a deal with you different than investing, in a REIT? So can you kind of give an explanation of what the differences are high level, right? If someone were to just invest in a REIT rather than investing in like a private placement into a deal with Goldhawk or a private deal itself.
Yeah, it's very different. You're investing in a REIT, you're essentially like it's the same as like buying a stock. And so first of all, you have zero control over anything that's happening. You put your money in, it's going into a big diversified portfolio with a manager who you'll never meet, that you'll have no idea what's going on or where the money's going, what's actually happening. They'll give like a quarterly report of like very high level of the business. So there's no control. The most important thing is actually the tax consequences here. So like you get taxes if you're like owning a stock. Whereas if you are investing directly in a private placement, you get a K1, and the depreciation benefits and all like the huge tax losses that we talk about with real estate investing can actually get passed to you as the investor, and you can take that if you qualify against your personal ordinary income to lower your tax burden, or you can take it against your other passive income. So there's huge tax benefits with that. Those are really like the big ones. There's a whole bunch of like other things like REITs can be subject to the volatility and the whims of the stock market and the company that is managing the assets.
Mhm.
Whereas, if you invest in individual private placements, you're really just investing in actual physical real estate, and it's more uncorrelated to what's going on in the market. So also the returns, I forgot to mention, returns are way, way higher in private placement deals usually than with REITs.
Yeah. Yeah, that's typically what um I discussed with them because you're buying a stock in a company that owns a portfolio rather than
Mhm.
buying and investing directly into a property in itself. To your point, like the tax benefits are a huge incentive when it comes to investing directly into the asset itself with the depreciation. And so, when discussing like your experience at the REIT, you went from you kind of touched on your journey with the small single families and small commercial multis into starting Goldhawk. So like what year did you get to the point where you spun up Goldhawk, and those first couple years of Goldhawk, what did it look like? What were you guys focusing on, and like what was your strategy there?
So Goldhawk, like, look, I'm the managing partner. I'm the founder of the business. I consider Goldhawk to be my entire track record, honestly. So like Goldhawk started when I made that first investment, but we just, did the formal branding and logos and website and everything like that, probably 3 or 4 years ago.
Oh wow.
Yeah, but since then, we've used that name and rallied around that name. Goldhawk, the way that these deals work for anyone that's listening, each deal has its own completely separate LLC entity, and then the investors will have their own LLC that they come into, and there's a whole convoluted organizational chart, like a web of entities that provide protection for all the people involved in the deal. Goldhawk as an entity essentially just exists to provide management services to the deal and collect fees. Investors come into a deal level LLC. The investors have their own LLCs. When I make my personal investment, I do it through a trust, an S corp, an LLC, through an LLC, through like I sometimes I'm 7, 8 levels deep before you actually get to me in if you're looking at the capital stack. But yeah, we use Goldhawk and the name Goldhawk essentially as like a marketing tool and also a manager in deals.
So you have a huge background in underwriting. Your recent LinkedIn post said that you had underwritten 185 deals so far this year.
Yeah.
Can you talk us through kind of some of your key principles and how does somebody underwrite 185 deals that frequently? You must be doing like 2 or 3 of these a day. So you must be very, very
Yeah.
quick
It's not
underwriting.
it's not just me. I don't do any, I'm not in the weeds ever anymore, which is great. When I was directly involved in the operations and just doing like deal by deal, one at a time, I was the one who was building the Excel models and crunching all the numbers on every single deal. Well, now I've hired a manager of investments, Chelsea, and another manager of investments, Jaden. And essentially, when an operator wants and they're under contract on a multifamily property and they're looking for an equity investment, they send me their Excel model and they send me their pitch deck and all their information. Chelsea will then go extract all the data points that we want to see, perform the calculations, and then make recommendations. I'll then pass the deal over to Jaden, who does a deeper dive. Jaden's like a traditional multifamily analyst, and if we want to do a deeper dive on the deal because it meets our no-go criteria, he will actually go and sometimes plug all the data into a actual Excel model of our own and re-underwrite the deal so that we can get a good idea. Typically, we're relying on the operators underwriting and then questioning their assumptions. Now, if it's a deal I'm looking to be personally involved in and on the operations side or, making a larger investment, of course, I'm going to go and do all the modeling. But for the 100 deals that come in every month that are asking for equity, we don't need to do that. First, we're going to weed out, 75% of them. And then with the rest of them, maybe 1 or 2%, we'll have to create our own underwriting model for.
And what are you looking for in your typical buy docs or underwriting models when you determine, an investment strategy? Like when you see that much deal flow, like, and you can already off the top, 75% of them don't meet the criteria that we're looking for. What do you typically look for?
Yeah. And so since what we're looking on behalf of family offices, institutions, and high net worth folks, their criteria is all across the board. Their buy box is kind of just everything now within multifamily. So we'll really look at all of the deals. Obviously, when we make a personal, like a direct investment through a feeder fund structure or, just with our own money, we have our own very specific buy box. But just to give you an idea of some of the metrics that people look for, and it's really this simple. The first thing is operator experience. We want to make sure that the company that's buying the property has done this successfully at least 5 times. And so that's really, we'll ask for the track record, and we just want to make sure they've been around long enough and have done the thing enough times to actually trust them to do it again. And then from there, we need to make sure they're buying the property at a decent basis. So we want to make sure the purchase price, which is essentially reflected by the cap rate or the yield going in, that needs to be competitive with other properties that have sold in the market. It needs to be at an attractive enough price that it's able to actually cash flow on day one when we buy it. Obviously, there's some heavy value add strategies that don't cash flow until later. Those, we mitigate that risk by making sure that the sponsor has a ton of experience and that stabilized cash flow is really strong. So operator experience, basis, or purchase price. The year one cash flow is really important to us. It's, we look at what's called leverage, and this is the spread between your going in cap rate on a property and the interest rate on the senior loan. And if that's a positive number, then that there is cash flow at the end of the day to pay the investors and to have solid yield. So what makes a deal competitive is when the going in cap rate is 50 to 100 basis points higher than that loan interest rate. That's like the most competitive deals. And so that provides the investor with year one cash flow. And we're usually looking for 5% or more in the first year for investor cash flow. And then the last thing that we look for that's really important is your stabilized yield or stabilized cash flow. So once the business plan has been implemented, what does the cash flow look like? And is that enough to justify the risk of getting into the deal in the first place? So on core plus deals where there's, it's a newer property with not a ton of work to be done, we like to see that stabilized yield be over 7%. And on value add deals where there's a renovation happening or a big business plan going into place, we want to see that stabilized yield be over 8%. That's kind of the things we look for. With our personal investments, we're very heavy on the Sunbelt market in more of those conservative landlord-friendly states. We have a lot of deals in Texas, Florida. We have deals in Arizona. We like the Carolinas. We have deals in Georgia. We're also starting to look at some more Midwest markets, so we might be expanding. But yeah, it's really about the deals, metrics, and the operator's experience more so than the geography.
Yeah, I think operator experience is, you mentioned it first. It's something that I think comes up at the top of everyone's list, usually first, because again, you want to work with people that have ultimately been there, done that have gone through these cycles. You mentioned there at least 5 times. I'm assuming you mean full cycle 5 times, right? Where they've executed the plan and then they've gone through either a refinance or a sale and returned investor capital and then gone on to the next one. So those are obviously, there's kind of 5 or 6 key things that you've mentioned, but I also know that you have a due diligence document that isn't 5 or 6 questions long. Can you talk us through how you came up with your due diligence questionnaire that is available on your website for anybody to download? And I've personally gone in and used this when I've evaluated other deals myself, because I think it's a really, really good starting point for people to understand what are the good questions that people should be asking, whether you are an expert in this field or not. It does give people a great base level of, here's some questions that you maybe haven't thought about that are important to ask. And there's also a kind of grading method that you put inside that. Not to say that if an answer is as appealing as you want, that the overall deal isn't a good deal, right? It's about managing the risk of all of those questions. But can you talk us through how you put that kind of due diligence questionnaire together? Because it's not 6 questions and you made that sound like you go through these deals just like that and you're like, yep. And you probably do at this point, quite honestly, because you've seen so many of them. But for people that are maybe investing in their first or are doing due diligence on their first few, can you kind of talk us through a little bit of how you put that together and why that's so powerful?
Yeah. I'm going to update that one because I've added like 20 more questions or 25. Yeah. So, when we are evaluating a deal for direct investment, there are so many things we need to review and be concerned with and essentially like check the box on. And so I was naturally doing this in my due diligence process, and I didn't have like a specific Excel sheet or something to actually like make sure I was asking all the questions and getting the answers and then following up. And it wasn't until I was trying to figure out what to provide people on LinkedIn with as like a free download. Like it wasn't until I had to do that when I came up with it. So I was doing van life. I was on a road trip. I think we were in Bozeman, Montana, and I was at the library there, and I was like, I need to like think of the most valuable thing possible for, real estate investors that they would give me their email address if I gave them this thing for free, because that's how I build my email list, and that's how I find investors for the deals. And essentially I came up with this idea of like, okay, all the questions that I ask sponsors when I'm trying to figure out if I want to make an investment, I'm going to put all of those into an Excel file, make it like a checklist, and then essentially provide that to everyone for free. So I put that together. I think, at this point, my checklist has like 230 or something questions on it. The scoring system doesn't matter at all. It's completely arbitrary. You can come up with your own scores and weights, but it definitely, like, these are the questions that you absolutely should be asking before you make an investment.
Yeah, it's super strong and important. And like Chris said, we've gone through it ourselves. And one thing, we really like when evaluating deals that you put out there is the amount of transparency that you have, right? When it comes to data rooms and really giving investors everything they could possibly want to know up front, so they don't have to come to you and ask 1,000 questions prior to deciding whether or not to invest in this deal. So can you talk a little bit about the transparency aspect of being a manager in a deal and really raising capital from investors and putting together a data room and what you provide to them and the importance of that?
What I realize is like 95% of the investors that look at my deals will never go into the data room and look at any documents in the data room. They're essentially investing because they trust me and my judgment and my 13 full cycle exits, a track record to prove it. Oh, it's really the 5% of like ultra sophisticated investors that are going in and looking through the documents, and they really, really appreciate that. Some operators, they only send you the pitch deck and the Excel model. I'm going to show you the insurance quote and the the tax assessment, like everything, like the
Yeah.
CoStar report, the market comps. Like I'm going to have all of the evidence that supports the assumptions in the underwriting model, like in there in a data room, so that you can see it. Of course, that leads to more questions, but the more that those investors dig in and ask the questions and get answers to those questions from me, the more they become interested in the deal. And they really do appreciate the transparency of having all the documents. There's nothing to hide. If there's something wrong with the deal, we will make sure it's front and center and disclosed. It'll be on the checklist. It'll be in the data room. You'll know what it is so that you can make the investment knowing what the risk is.
And I think that's such an important part of being right. And essentially, a managing member of people that are trusting in you to, invest in these deals and do the underwriting is the transparency aspect of using your experience and leveraging that, within that and being open to that. So when it comes to that, you've obviously had a great success and track record in raising capital. What are some of the strategies that you've implemented outside, right, to be so successful? Like, how big is your list now? What are some of the strategies that you're putting in place? Because, like, I've seen some of your LinkedIn posts go absolutely viral and just like bazooka, like they
I'm,
just
I'm
blow up.
horrible at raising money.
Some of your
It's
LinkedIn posts, I can imagine the
so
impression.
tough right now to raise money. Like before the interest rates went up, actually like before COVID, it was like so much easier to raise money.
Mhm.
And now people are really worried about what's happening, and so like raising money is like pulling teeth right now. It's tough. Some of the strategies that I've used, obviously posting on LinkedIn, I've actually gotten kind of burned out with that lately. A lot of the folks you interact with on LinkedIn are not the actual people. They're either, AI robots, or it's like people trying to sell you stuff, and they're not like genuine, connections. A lot of
Mhm.
like the actual investors and like genuine people who, are not trying to sell you something, they have left LinkedIn, or they don't look at it anymore because they've just been so inundated with sales pitches. And like I get 20 messages a day from people trying to like sell me something. And so, I've kind of not been using it really in the last few months. But yeah, it's a very effective tool if you do it every single day consistently, and you spend, an hour or two babysitting all the posts and engaging with everybody and everybody's content and stuff like that. But you got to make sure that your posts are actually like, when a post goes viral, you got to be able to convert those into leads. A lot of people don't realize they have to do that, and so to do that, you need to capture the email somehow. So what I've done is given away free products like the due diligence checklist, other, an Excel underwriting model. I have my top 7 metrics that I look for, PDF document, stuff like that has worked. And then aside from that, just word of mouth, really, and repeat investors, friends and family. Most of my actual investors don't come from LinkedIn; they just come from people who have known me for years.
Right. You've done right by them and you've shown them success, and referrals go a long way. And then repeat investors are
Yeah,
are worth a lot.
yeah.
So, with that being said, of how difficult raising capital is right now, Elijah, I want to bring you back to one of the first things you said, which is how much you disliked being an operator. So, why have you decided, other than the obvious dislike for being an operator, can you tell us a little bit more about why you dislike operating so much and why you've gone down this path of being that almost glue to connect operators to investors and family offices instead of going down the operating or the operator route and being vertically integrated and all of that stuff?
Being an operator means you have to be physically in your local market at all times, dealing with issues and like ready to put out fires in the middle of the night. It's not passive at all. It's a very, very work intensive type of thing. You're getting calls every single week or maybe even daily with fire drills. I always hired a property manager, and I would get a call every single week that something catastrophic has happened. It's always another call. Like, I think a few months ago I got a call. Oh, the main water line broke. Like, great, $15,000. There was a shooting at the property, or tenant one punch tenant number three, who are you going to evict? Or like, someone stole this, someone stole that. And there's always some crazy issue that's going on. And it just kind of, it wears you down to have to deal with those fire drills every day. As the capital raiser and the underwriter, my job pretty much ends on the day of closing. Of course, you have to follow up and keep in touch and review the financials and ask the right questions of the actual operator, and the asset manager. But I make a lot more money for the amount of time that I spend on it now, because I'm not staying in the being involved in the day to day, and that allows me to do a lot more deals. So I can do 4 or 5 of these deals every single year, whereas if I was an operator, I'd probably get to like 2 deals a year and be like, I can't do anymore. So that's why it's a brutal game to be the operator.
I
And
think that's go ahead, Brian.
that goes back to what you were saying earlier about, investing with an operator with a track record, right? That has shown strong success, over the last decade or 15, 17 plus years. They've been through, potentially '07 to '09. They've been through COVID, right? They've been through the interest
Mhm.
rate spikes. They've gone through market cycles, and like, not only that, like managing the properties, right, and keeping
Yeah.
occupancy highs and efficiencies, the properties going through all of the turbulence. And that is why we talk about operator track record as like often the number one,
Yeah.
metric we're looking for when partnering. And everyone's got to start at one, right? There's probably another operator that's coming up right now that's closing on their first deal. It's going to be like the next, new and upcoming operator. But I think that's so important. So, and speaking on that, and like how tough capital raising has been, since, the last 24 months with the rise in interest rates and everything that's going on, and some of the
Mhm.
turmoil. We've had a presidential election, and we've had a lot of change and turmoil in the market. Where do you see the market right now, and the runway for investing in multifamily in 2025 and 2026? Like, do you feel like this is a really opportune time to get into deals with upside we're seeing the next 5 to 7 years? Like, what's your outlook on that?
Yeah, I think it's the best time, the best opportunity we'll see in our lifetime, or in a generation at least, for buying. Right now, it's really like, think about it like a supply and demand thing. When we invest in real estate, it's a long-term strategy. You can't invest in a liquid asset with a short-term strategy. You need to take a longer term approach to really unlock that value. And if you look at like the supply and demand problem, like fundamentally there's just like a massive shortage of like housing when you compare it with like how fast the population's growing, especially in like cities that people want to be in. Now, in the last couple of years, what you saw was a huge oversupply in some of these cities, the super high demand areas, and that was a result of like really low interest rates, like really cheap money that they could borrow, which essentially allowed them to build buildings at a lower cost than it would cost to like actually like buy them to buy an existing building. And so there were so many construction projects that started 3 years ago, 4 years ago, 3 years ago, and were delivered over the last few years. And but what happened next was that the interest rates went way up. And when that happens, it becomes extremely expensive to build because so much money is going to a bank. It essentially becomes way more expensive to build something than to actually buy an existing building. So construction starts have fallen off a cliff when the interest rates went up, which essentially means that 3 to 5 years out from when the interest rates started going up, there won't be as many new apartment buildings delivered. And so all of that oversupply, in my opinion, is going to be absorbed by, if not the end of this year, halfway through next year, and we'll
Hmm.
be back to the same situation we were in before. We were short 5 million housing units, and it's going to get way, way worse from there, because I don't think interest rates are going to be going back down to 2 or 3% anytime soon. So if you look at it from like a supply and demand perspective, I think it's like great. Also, as crappy as it is, I don't think there's any way that we can avoid out of control inflation.
Hmm.
It's just something that happens, and when there's inflation, asset values go up, the price of goods goes up, rents get more expensive. When rents go up, the property values get higher. So, and I think we're like in that zone right now, right before right before the prices start going back up. I think you probably got another like 6 months, maybe even 12 up to 12 months where the supply won't be fully absorbed, and you'll have an opportunity to still buy before prices shoot through the roof. And then like let's say interest rates do come down. Let's say the right now 5.25% for a fixed agency loan. What if that goes down to like 3.5% or 4%? Well, property values are going to go crazy high because everybody's going to be buying because the cost of capital is cheap. So either way I look at it, I think it's good for the long term for owning apartment buildings. What you're seeing right now is an interesting situation where cap rates are still kind of low, which means prices for property are still somewhat high. And with the high interest rates, a lot of deals don't pencil because there's just not enough cash flow there. Like the money is literally just going to the bank and then there's nothing left. And that's a result of sellers not yet ready to capitulate. What you saw is a lot of these people that have loans that are expiring. The bank doesn't want to take those properties back, so they'll just keep extending the loans. And the sellers aren't, unless there's a gun to their head, they're not going to actually sell at a low price. And so they're like, oh, well, we bought this property at a 4% cap rate a few years ago. There's no way we're going to sell it for a 6% cap rate now because that hurts. And then you actually realize a loss. Whereas if they can just hold as longer and longer and longer, maybe they'll get lucky and cap rates will come back down. It's an interesting situation. So it's not too many deals make a lot of sense, but the ones that do, it's a really great opportunity to buy in.
Yeah, I think I would actually agree with essentially everything that you just shared there. I think a lot of what I'm looking at right now when I'm going through kind of evaluating these deals is the market that they're in. And one of the things you just mentioned there, Elijah, is that in certain areas there's been a lot more supply that has been built in these markets. Is that why you are moving away from some of the Sun Belt into like the Midwest areas, or is that just because of population growth in those areas? Like, why is it that you started kind of in Florida, then you went to the Sun Belt, and now you're kind of moving up towards the kind of Midwest? Is that one of the reasons, or is there a number of other ones as well?
When I was an operator, I really believed that it's really important to focus on one specific geographic region, one city at that, to become an expert there, to get the deal flow there, and to know all the vendors and the brokers and everything there. And as I've transitioned to more of a capital raiser, allocator role, investor role, it's less so about having the local market expertise and more so about relying on the operator to have that experience. And so that allows me to diversify my geographic presence, and just rely on local talent to essentially know about that market and get the deals in that market. Like I don't need to know all the brokers in Dallas, Texas, because these 10 companies I have a relationship with are getting first look at every single deal already. I'm just gonna invest in their gift. So at first it was Florida. Then we realized that Florida was, we had made a lot of money in Florida and we wanted to sell at the top. So we did. And insurance costs were rising like crazy. So we went to Arizona and caught the tail end of the big bull market there. I got stuck holding some properties. We had to refinance and hold. And right now it's not a great time to sell in Phoenix, but we established a presence there. And then we got into the capital raising game for others, and we started going to different areas within the Sun Belt because we thought the population was moving down to these areas, specifically Texas. And then from there, I started realizing there are great deals all over the place. Still fundamentally for my own investment purposes, I like to invest in conservative areas that are landlord friendly. And so you're not going to see me investing in California or New York, but there are some other places that I really like Kansas City, that I think a lot of people are moving to because there's a lower cost of living and it's warm, and there's a lot of benefits there. So I'm starting to look at other locations.
Yeah. Cash flow still seems strong in the Midwest with where pricing is and kind of where the rents demand, which is, and there's just not as much development in the Midwest. Like people like fall in love with Texas and Florida and all these, flashy states, but there's just not as much development in the Midwest. We've talked to operators in Kansas City too, and it seems like there's a strong migration there of investors coming into that market as well. Speaking of that, what's your Rolodex look like of like operators that you have a relationship with? I can imagine like the amount of contacts that you have of operators in the space.
We have about 500 operator relationships, and we email all of them like once a month or every other month to ask if they have any deals. That usually, once I send that email out,
Just get flooded.
I probably get like 200 responses. Great.
That's crazy.
Yeah, we get a lot of deals from that. I mean, anytime anyone's ever sent us a deal, or sent us a deal on LinkedIn or email or whatever, we add their contact info to our CRM so that we can reach out to them later, and we built up that list.
That's awesome. So on that point, you have obviously a great operator list. You've done a great job of being a connector of high net worth, family office, of institutional investors to a bunch of operators that are buying these properties. Now, what's next for Goldhawk over the next 3 to 5 years? Like, where do you see your business going, and what is your goal as you continue to grow the business for yourself?
Yeah, I see Goldhawk essentially morphing into a boutique real estate investment bank, where we're not just raising capital. We're providing transactional services. We're doing underwriting, preparing marketing materials, organizing the whole capital stack, and then managing the transaction as well. So that's one thing. And then on the direct investment side, because right now we do individual deal investments, I'd like to have a discretionary fund with a couple $100 million in it that I can go and invest. So that's also something on the horizon.
Yeah, like you could be either the lender or a bridge or pref equity.
I'll be the JV equity partner through the fund of funds.
Got it. Cool. Yeah, I mean, a lot of options with where you can take it if you grow the fund to that size. But that's awesome. That's based on the track record so far. I see you guys on a strong path to get there at some point.
Yeah, hope so.
Well, Elijah, this has been really, really insightful. I've got one final question before we do wrap this up, which is, what advice would you give to either a new operator or a new capital raiser, given that you have been in both positions? If you could give each of them one piece of advice, what would you give them?
For operators, if you don't have that extensive track record we were talking about, go partner with someone who does, so that you can go be a part of transactions. And if you're on the GP team, you can count those transactions in your track record if you're playing a material role in the deal. So go tack yourself onto someone else's deal, and they will provide the track record, and will be a lot easier to raise money. For capital raisers, this is tough because it takes years and years and years to build relationships with investors. Honestly, I think it's important to go spend a few years working at a private equity firm and learn the ropes, be the analyst, get onto the capital raising side of it, and learn from the institutional professionals, and then really just start building up your Rolodex, your list, and communicate with that list frequently, build those relationships, so that in 5 years from now, when you do have a deal of your own, they invest. But it's a very difficult thing to do. That's why I do it, because very few people will. And if I can figure it out, then I can make a lot of money. But it's very hard to do, and it takes many years to build those relationships.
Yeah, that's a great answer. But again, we thank you for hopping on. You shared a ton of awesome advice today, and obviously your track record speaks for itself. And I wish Goldhawk continued success in everything you're doing. And hopefully we're at the bottom of the next bull market here in multifamily over the next decade. But I appreciate you hopping on today and sharing all your bits of advice, and look forward to talking with you again soon.
Thanks so much, guys. I really appreciate it.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals, and let's reach new peaks together.